right, we got less than 30 seconds to go until the opening bell. We're looking at Compass, by the way, about to ring it at the New York Stock Exchange after Jay Powell said the housing market has bottomed. That's why they're so excited. We're looking at gains in futures, and we could see a 7th consecutive day of gains on the S&P 500. That would be the longest winning streak since at least 2021. Let's take a look at what's going on across assets here. The euro continues to rise as the ECB says it'll raise rates probably at least until September. Meanwhile, the Fed is on pause, so the euro looks more attractive. The 10-year yield rising right now to 3.77, although we just heard Morgan Stanley thinks it's going to come down to 3.50 by year and 3.30 next year. NYMEX crude holding above $70 a barrel, 70.58. Not doing a lot today. Traders waiting to see if China is going to add any more stimulus to this market. The one stock to watch at the open is Kava, the fast casual chain, almost doubling in its trading debut yesterday. The CEO, Brett Schulman, saying, quote, "The market's always welcoming and ready for long-term sustainable growth stories, especially ones that are category defining." That's what we're trying to do in the Mediterranean cultural cuisine category. Abigail Doolittle joins us with more on this IPO. So, Abby, did they leave some money on the table?
Well, I think the bankers, I think that they should maybe be talking to their bankers about that possibility, because it was either horribly mispriced or, given the fact that the stock was up 99% yesterday, investors just raring to get back into some hot stocks. It could speak to the lack of breadth that we've had. So today the stock is still up 3.2%, but that pales in comparison again to a 99% first day gain. They raised $318 million from the IPO. But again, the fact that there was such a massive gain does beg the question of whether or not the bankers mispriced it. I would also say that something else to think about here, Matt, is the fact that this year's big tech rally, the NASDAQ 100 up 40%, the small cap index up less than 10%. We keep hearing about investors pushing for breadth in terms of different sectors. So the fact that this is not a tech IPO, maybe that was a piece of it, a piece of the logic on the part of investors who got into the IPO. But yeah, it's a little bit defying, and you have to wonder whether or not it's going to embolden other companies to start to go public, since there's been such a dearth of initial public offerings this year.
We can only hope. Abigail, thanks very much for that. Let's turn to tech now, because Adobe's second quarter results beat expectations after the bell last night. The software giant also raised its full year forecast based on its artificial intelligence ambitions. The CEO saying, quote, "Adobe's groundbreaking innovation positions us to lead the new era of generative AI, given our rich data sets, foundation models, and ubiquitous product interfaces." Katie Greifeld is here with more. Katie?
Hey, Matt. Yeah, Adobe went big on those AI products in its earnings call last night after, like you said, it reported a beat and raised quarter. Just to go through some of the numbers here, we have sales now seen at $19.3 billion this fiscal year. The previous forecast was for $19.2 billion, so a little bit of a boost there. Adjusted profit also now seen at $15.75 a share. That is up from the previous forecast of about $15.60. And really the hope here is that these generative AI tools will help fuel demand for Adobe's software. Now remember, last week, of course, the company unveiled enterprise-level subscriptions for those new AI tools, and that was a big boost to the stock last week. It's continuing through to today. You did have Wolf Research note that there's still some uncertainty over that Figma deal. Of course, not really holding shares back this morning, though, currently up over 4%, Matt.
All right, Katie, thanks very much for that. Tied to the AI craze, or maybe anything internet, is the security firm Palo Alto Networks. Wedbush analyst Dan Ives raised his price target on the stock to $290 from $225, which has easily eclipsed in its 75% climb year to date. The new target implies a 19% increase from here, and security is something that you're always going to need more of on the internet. Let's turn to the auto sector now. Rivian quickly ramping up production of its electric SUV. The company's CFO saying output of its R1S model is on track to overtake production of its pickup truck. Bloomberg's Ed Ludlow joins us now with more. Ed, what do we know?
Yeah, so Rivian stock trading at the highest levels since late March, getting a boost on this. Basically, all of the focus for Rivian, particularly around the time that it went public in 2021, was on its R1T pickup, because it was the first battery electric pickup to market, to actually get into customers' hands. But two key pieces of information from the CFO Claire McDonough at the Deutsche Bank conference yesterday. The first is that in the coming second quarter, the R1S SUV will outpace production of the R1T pickup. 70% of the pre-orders that Rivian have are for the R1S. And, when you think about the landscape of the electric vehicle market here in North America, there isn't really a true battery electric SUV out there other than the R1S. We know that Ford and GM are coming with models, but if you think about the Model Y and Model X as a comparator, yes, technically they are three-row SUVs, but R1S is a real boxy one. Again, we're trading at the highest level since March. Where are we? $15.45 a share, nowhere near $172 of the post-IPO boom.
4 motors, 835 horsepower. Truly unbelievable stats for the R1S. Ed, thanks so much for joining us on that. Let's stick with transportation here in form, I guess. Virgin Galactic announcing a date for its long-awaited passenger mission. Billionaire Richard Branson's space tourism company saying June 27th will mark the beginning of commercial operations. Kaylee Lyons is here with more. Kaylee?
It's really hard not to use the blasting off pun here, Matt, because this stock is flying right now up 38%. It did actually open with a record gain, though at this point this would be the biggest gain for the stock in 2 years if it holds. And we have to keep in mind it's still down about 90% from its peak back in February of 2021. But still a very large gain at the open here on this news. Galactic 1 will be launching at the end of June. It will have Italian researchers on board. And of course, this comes after a number of delays. Then there will be Galactic 2, the company says, launching in August. And they actually did hint that that may actually include space tourists who put initial deposits down years ago to get on one of Virgin Galactic's ships. So this really is the start, hopefully, in theory, of the company's commercial space flight. And analysts seem very positive on this announcement today. KeyBank said this would be a major milestone. Morgan Stanley saying that this is an opportunity for Virgin Galactic to restore credibility around its flight schedules. And again, massive gain for the stock here, up 37% at this point in the trade, Matt.
Do we have any idea, Kaylee, how much a ticket's going to cost?
6 figures.
Yeah, I saw $450,000. All right, Kaylee Lyons, thanks very much for that. Let's get to JP Morgan's Tom Kennedy right now, trying to make sense of the Fed's actions, writing, quote, things are moving in the Fed's direction, but taking another month to see how the economy evolves can't hurt. With policy rates at their highest since 2007, growth momentum is waning. Yes, things are slowing down, but from a pretty strong pace, it's unlikely they need to hike 2 more times. Get invested. Tom, I'm pleased to say, joins us right now. So, yeah, it doesn't seem like the market even buys 1 more hike at the moment. Tom, what's your view on how long they're going to have to wait and see?
Yeah, good morning, Matt. I think the slowdown in the U.S. economy is well underway. That's really the reason to pause, at the very least, skip the hike this month in June. When you look at why you should expect the slowdown, I think it's really easy to look to CapEx in America, which is slowing. Tight lending standards suggest it should slow further. And then the beloved consumer in America is resorting to debt to keep their lifestyle up. That can't last forever. And delinquency transitions, so things that consumers that were not delinquent last quarter that are now delinquent is increasing. So the Fed is getting their evidence, Matt, that the slowdown is coming. But like any good investor, they're risk managers. And seeing is going to have to be believing. Unfortunately, like most of us, they initially misread the inflation surge, and now they can't let that happen again. So the most likely scenario is they're going to have to see labor market balance and more likely layoffs to be sure they've gotten the job done. So risk management phase for the Fed right now, but I think you'll see the slowdown. I think in the next quarter you're going to see a meaningful deceleration in hiring in America.
Well, and even so we see the economy slow down is what you're expecting, and maybe the Fed hikes 1 more time, maybe not, but they're not cutting this year, right, Tom? What does this mean for the equity markets when we're looking already at pretty much S&P 4,500?
Yeah. Man, I think this is what the market is trying to differentiate is, will that breadth that Abigail talked about actually be restored? For most of this rally since the end of Q1, it's been mega cap led. But over the last month or so, you've actually seen other firms, more cyclical firms, start to catch up. What the market, I think, is focusing on is the fact that trend inflation in America is not 4.5% like it was a couple of months ago. That this week, Powell didn't really acknowledge that his super core measure of inflation, core services ex shelter, has meaningfully stepped down to about 3.5% from 4.5. This is really important in that the Fed is, number one, rates are more restrictive if that's true. And number two, in the event he gets this slowdown or layoffs like we're expecting, he can actually cut rates sooner than what people had originally thought. Again, he doesn't need inflation to go that far. 3.5 is pretty close to 2. So the market is thinking maybe this will be a shallower recession than originally thought. We're trending in that direction too, and some assets are not reflecting that shallower recession. Things like mid-cap equities in the U.S., where you can get really good allocations to secular ideas like the green energy transition. Oh, and Matt, these things are relatively inexpensive. And then lastly, you look to Europe. In JP Morgan's global community, you have significant underweights to Europe. About 50% of our clients are underweight Europe. But again, secular ideas are abundant there. And again, inexpensive. So we're looking for valuation support to get our clients to move into those ideas.
In Europe, I think it's interesting that the ECB feels it's necessary to continue raising rates till at least September. Yeah. Does that bother you, or the concern that the euro is starting to gain so much strength against the dollar?
It is worrisome, Matt, that you have core inflation in Europe that really hasn't rolled over like it has in America. For the ECB, I think this means that their risk of entrenched inflation is still elevated there, or at the very least elevated more than what we're thinking in the U.S. It means they have to keep pushing, and they do have to keep hiking. Is it worrisome? Yes. I think we're late business cycle in both U.S. and Europe, but that valuation support in Europe is really important for us. You're seeing about a 30% discount in European stocks relative to the U.S., and even Europe within its own historical averages is trading cheap to its own history. So there's valuation support, which gives us a lot of confidence to make that move to get reinvested back into that space.
You bring up the history, Tom. I was hired by Bloomberg as a stocks reporter in Frankfurt, Germany in 1999. I've spent half my life over there. There have been many years where we think, okay, this is Europe's year. European equities are going to outperform, and it's always a head fake, right? They're always discounted versus U.S. stocks. What would give you more confidence to say it's really going to happen this time?
Yeah, Matt, it's important to recognize. You haven't seen European outperformance in a sustained way for a decade and a half. Fully acknowledge it. Very good pushback. I think what's different about this path forward is that there is non-economic or non-interest rate sensitive investment that needs to happen in the Europe and in U.S., and the European indices have more exposure to those types of investment, whether they be security, whether they be industrial, whether they be real economy. And it gets thrown around a lot like new regime type of conversation, Matt, but there are new industrial policies across the world that are emphasizing this real economy investment. That should favor Europe, and for the last 15 years, that hasn't been the case.
All right, let's get back to the U.S., Tom, because yesterday's rally felt like very euphoric, especially in the last hour of trading. And I know there were record shorts against S&P futures, and maybe there's some covering there, but is it possible that everyone got on board last night? I mean, is there anyone else left to buy?
If you look at our JP Morgan community globally, yes, there is more capital to be invested. We have, since the rally started in October, Matt, you've only seen 7 or 8 weeks where our clients have been net buyers of equities. So we have been, in our own internal community, really raising a lot of cash. So there is cash out there, and we are one of the biggest aggregators of wealth in America, so they're still there. A really important stat, Matt, in our community, again, JP Morgan wealth management community, over 25% of our investable assets are in cash and cash-like equivalents. For our clients, not going to help you get to your financial goals, but it is in line with your point. There is cash out there to be invested. I agree with your point. I think you still have, in the near term, if you want to call it a pain trade, it is to the upside. But doing it in a diligent way where you have valuation support and still acknowledge that you're in the late cycle environment, there are ways to play equities. I just think it's still on the defensive side of things.
All right, I look at MMFA index go on the Bloomberg terminal, Tom, and I still see $5.452 trillion in money market funds. So yeah, there's some cash on the sidelines. Great talking to you. Tom Kennedy, really appreciate your insight from JP Morgan Wealth Management. Coming up, Tesla's charging network is building buzz after getting buy-in from Ford and GM.
I think there'll be competition in the space because essentially what Tesla's done here is they've open sourced their technology to the industry. There are 40,000 fast chargers in the U.S. There are 4 million in China. It just gives you a sense of the growth that we're going to see here as we convert from gas cars to electric cars.
That's next. This is Bloomberg.
Tesla has a very good charging network, and it's good for our customers to be able to participate in that. We don't see ourselves giving it away to Tesla. What we're doing is we're opening up the Tesla network, working with Tesla, and providing that for our customers.
Tesla snapping its longest ever winning streak, unwinding after a 41% surge. That rally fueled by legacy automakers announcing plans to join Tesla's EV charging network, investor appetite for AI stocks, and more. Meanwhile, Elon Musk is set to meet French President Emmanuel Macron today about the possibility of building a factory in northern France, and he's going to have lunch with the other richest man in the world, Bernard Arnault, in Paris. Bloomberg's Ed Ludlow is back with more. This got exciting quickly, Ed. I mean, first Ford and then GM, plus it was on Twitter Spaces. It's like, great, everything's falling into place for Elon Musk.
Yeah, from Ford and General Motors, there was a real emphasis on the reliability of Tesla's network. Our colleagues at Bloomberg New Energy Finance have crunched the numbers, right? And the reality of it is that the NACS standard, North American Charging Standard technology that Tesla started putting out there in 2012 is the most accessible in North America, here in the United States. It dwarfs all of the CCS charger providers put together in this country. And as Dana Hull's been writing, it's kind of become Tesla's shrewdest product. There is a range of estimates out there in terms of what the top line ad could be from allowing others to use your charging network, just selling them the electricity, the time and the use. And it's something we haven't really talked about for the last 4 years, at least since I've been here in SF.
It's a great point. I've tried to use the other non-Tesla supercharger equipment out there on both sides of the Atlantic over the past couple of years. It's no fun. They often don't work, or you're waiting in long lines.
Yes.
Is anybody, even a consortium of automakers, going to be able to challenge Tesla's supercharger network?
Well, in the first instance, on Monday of this week, many of the charging providers, Blink, EVgo, Wallbox, for example, said that they would offer ACS alongside CCS here in the US, which tells you everything. You have to go back to the history of what happened. CCS was born in 2011 when Ford, GM, Volkswagen, BMW got together and said, hey guys, we should probably have the same types of charger, both here in the US and Europe. It was well-intentioned, but that's not what happened ultimately. We have slightly different standards between the US and Europe when it comes to CCS, multiple standards in Europe. And then you think about China, where there are many orders of magnitude greater installations of charger. They have their own standard anyway. So, Tesla certainly is seizing on it here.
Ed, thanks very much. Ed Ludlow there from Bloomberg Tech. Let's turn to Microsoft now, the tech giant on a winning streak as it quietly positions itself to dominate the AI market and discourse. Bloomberg's Katie Greifeld is back with more. So, Katie, it looks like Microsoft, it's all coming together for them in terms of using AI to cash in.
I would say they haven't been too quiet about that either, that they have very big AI ambitions here and that they want to be the leader when it comes to AI. And it's early. It's very early in this AI arms race, but many are saying they have established themselves as that leader. There's some great reporting on the Bloomberg terminal by Dina Bass and Max Chapkin saying that according to people familiar with the partnership, Microsoft has invested $13 billion in OpenAI since 2019. Of course, OpenAI is behind the very popular chatbot ChatGPT. And as a result of that investment, Microsoft is OpenAI's largest shareholder. It's its biggest financial backer and its key technology partner. There's, again, great reporting. They quote Kim Forrest. She is the chief investment officer over at Boca Capital Partners, saying that they're the clear leader and that Google just got completely leapfrogged here.
Yeah, the cool thing to me is that I finally kind of get the strategy, right? They can use AI to make money on not just ChatGPT, but also on GitHub and also with their Windows products. So they can start cashing in, and Google still doesn't even have an AI-assisted search.
Well, it's interesting. Again, if you look at the commentary from the different CEOs, I mean, some of this is by design. Of course, Microsoft is really putting this forward. They want this to be a sort of Windows 95 moment. And then you look at the commentary from the Alphabet CEO in April saying that basically there's been many changes in the search business over the years, that this is just part of that evolution. And of course, you might expect to hear that given that Google is obviously very dominant in search and they want to maintain that they're the leader.
Katie, thanks very much. Katie Greifeld there talking to us about the big take, which will also be in the upcoming edition of, or the current edition, I guess, of Bloomberg Business Week. Coming up, the market moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
At that all day yesterday.
Let's get to the trading diary, what you need to be watching through next week. You missed consumer sentiment at the top of the hour. U.S. markets closed Monday for Juneteenth. On Tuesday, Fed speak from Bullard and Williams. Fed Chair Powell testifies before the House on Wednesday, and Thursday you get the BOE rates decision. This was the countdown to the open. For John Farrow, I'm Matt Miller. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, June 16th. Here are the top market stories that we're following for you at this hour. Big rally, then big collapse. Bank of America isn't convinced the S&P is in a shiny bull market. We're going to get the latest read on the consumer with University of Michigan survey dropping right now. And a sustained tightening bias. IMF says Europe needs more tightening to beat inflation. We're going to speak first to the IMF chief, Kristalina Georgieva. And big tech goes to Europe. Intel will invest as much as $4.6 billion to build a facility in Western Poland. Germany looking at subsidies for the company. Macron tries to woo Elon Musk. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, looking at the equity market, it doesn't look exciting. However, overall, we're looking at really solid gains this week all across global equities.
Yeah, and who'd have thought that given what we've just seen from central banks, which sounds very, very hawkish with the exception, of course, of the BOJ. We pretty much got what we expected this week. The equity market continues to take it as incredibly positive, but all these central banks, Alex, remain incredibly data dependent. And the data we're getting right now is very interesting.
Yep, it looks particularly strong in some areas. University of Michigan index breaking. Michael McKee is going through those numbers for us. Hey, Mike, what do you got?
Well, to quote former Vice President Dan Quayle, happy campers you are, happy campers you will be. A big rise in the University of Michigan's Consumer Sentiment Index goes to 63.9 from 59.2. The expectation was it would just rise to 60, so a big beat there. Current conditions at 68, much better than the previous 64.9, and we get a big rise in expectations. Now that's kind of interesting. 61.3, 55.4. Now, these numbers are often influenced by things like stock markets, jobs, and gasoline prices, all of which have been in the good news camp lately. So perhaps Joanne can tell us about that. But the inflation numbers are what are really going to make the Fed happy. Look at this. Michigan one-year inflation, 3.3%. It was 4.2% in their last survey. The 5 to 10-year inflation number comes in at 3%, down from 3.1. A huge drop in what people think is happening with inflation, and the Fed believes that expectations make a difference. So this is all good news for the Fed and their soft landing scenario. Not saying we're there yet, but it should make them happy as they go off for their weekend.
Mike, great stuff. Thank you very much indeed. That one-year number, gasoline, you just have to wonder how big a factor it has played. We have seen a significant downdraft in energy prices. Are we going to see that bottoming out? Is it about to pop back up? Let's get careful analysis, deep analysis. Joanne Shu joins us now. University of Michigan Surveys of Consumer Director. She's going to walk us through all the minutiae of these numbers and what it all means for us. Joanne, how should we be reading this data?
Well, this improvement that we saw this month is primarily being supported by two things. One is the resolution of the debt ceiling crisis, which had really created a sense of unease among consumers. And of course, more importantly, and most importantly, is the slowdown in inflation. This is something that consumers have noticed in a number of arenas, not just gas prices, but durables, autos, and cars, and houses as well. And consumers have noticed that.
Joanne, I mean, that one-year inflation expectation is a pretty chunky drop, down to 3.3%. Do you expect it to stay at that level?
Well, for the last couple of years, since the rise in inflation, uncertainty around inflation has been quite elevated. And in fact, earlier in 2023, inflation expectations, this one-year number, bounced back and forth for 4 straight months. Now we have 2 consecutive months of the inflation expectations coming down. I think that is the trend. It may still wiggle, but I don't expect it to spike in the way that we were seeing before.
Do you think the Fed should be happy or unhappy with what they see in your data?
I think they should definitely be heartened by the fact that consumers are passing through what they see in the slowdown in inflation into their expectations. But I do need to point out that while the one-year expectations have come down so dramatically, the 5 to 10-year, the long-run expectations have remained extremely stable. For the past 2 years, it's been between 2.9 and 3.1%, which is elevated relative to the 2 years prior to the pandemic. That hasn't moved at all.
No, fair enough. I mean, it's been super super sticky right at that level. Joanne, can we break down the sentiment or the feelings around inflation based on income group? Can you talk us through what you're noticing on that level?
Actually, the optimism on inflation cuts across all different demographic groups. High-income and low-income consumers, older, younger, more educated, less educated, everyone seems to believe that inflation is slowing down in the year ahead.
Yeah. What do you think, what does your data tell you about the connection between the labor market and what people experience, what people expect when it comes to inflation, Joanne?
I mean, I think that is definitely an interesting question, particularly given the very strong labor market. I think that the labor market strength is really something that's going to affect more on consumers willing to spend and their overall sentiment than their inflation numbers per se. So far, strong consumer spending has been supported by a strong labor market, but one possible factor that may cause policymakers pause is the fact that consumers are starting to exhibit some signs of weakness, or they're starting to expect some signs of weakness in the labor market, particularly younger consumers.
Oh, interesting. Joanne, are we seeing any fatigue here, consumer fatigue anywhere?
Well, they're certainly tired of inflation. So the fact that inflation is slowing down is definitely good news. But 43% of consumers still are telling us that high prices are weighing down their living standards. And they're still complaining about high interest rates for cars, durables, and homes. So they are tired of this situation. But so far, things are definitely looking better for them than they were a year ago when sentiment was at its all-time low last June.
Joanne, it's interesting. The 2-year initially dipped, the yields, when your data dropped onto our screens. It's now climbed back. If you were to look at the totality of the data here, and I want to come back to the question I asked you about how the Fed should be reading this, is the Fed going to look at this number and say, we're not hitting the consumer hard enough? Yes, inflation expectations are coming down, but we probably think a lot of that is gas, and as a result of which, basically, this is a tax break that has been given to the consumer, who are then going to spend that extra money, and that's going to continue to ultimately support inflation over the long run. Is that a reasonable takeaway from the data we are seeing?
That's one possible takeaway, but it's certainly not the only takeaway. The fact that consumers are starting to see some weakness in the labor market, there are most demographic groups actually downgraded their expectations for both inflation adjusted as well as nominal income over the year ahead, which means that in spite of the fact that prices do seem to be more manageable for consumers, they don't necessarily have the incomes to support it. So it's not necessarily the case that this increase in sentiment, that this improvement in inflation expectations is going to lead consumers to go gangbusters in the months ahead.
But, Guy, this does raise the question of, are we actually in a soft landing? Sure, we're not going to go gangbusters. That's not a bad thing. But being able to still feel okay and buy the stuff you need to while your feelings about inflation roll over, like, isn't that thing the Goldilocks, the soft landing that we thought was so far off?
It's interesting that the Fed in some ways has separated out what's happening with the labor market and what is happening with inflation. Certainly some of the latest research that's being done maybe suggests that connection isn't as tight as we thought it was. So yeah, inflation expectations come down. That is a good thing. That's ultimately what the Fed wants, because it doesn't get embedded into the labor market in terms of wages. But I still come back to this whole idea, and I appreciate what Joanne's saying about not going gangbusters, but nevertheless, this doesn't feel like an economy that is slowing down sufficiently. And I'm surprised it's not slowing down sufficiently given the 500 plus basis points that we've already had.
Yeah, so Joanne, if that's the case, is there something on consumers' mind that would make them more constricted? I know you mentioned inflation, but last time we talked, it was the debt ceiling. Is there something like that on the horizon that we can look to or point to?
I really think it's all about the labor market at this point and how confident people feel about their incomes. Like I said, they don't feel nearly as confident about their incomes as they did just a few months prior. We've been in a historically strong labor market, so there's really not much room to improve. So given that consumers are feeling less confident about their incomes, that could be something that will lead them to pull back their spending, but not necessarily in any sort of cliff-like way.
Yeah, exactly. Soft landing-ish. Joanne, thanks a lot. We really appreciate it. Love the instant analysis. Joanne Shu, University of Michigan Surveys of Consumers Director. Thank you very much. So coming up, all of this leading to, surprise, A mild rally in the equity market. S&P up 0.2%. You have the 2-year yield now at the highest level since March of 2023. Global stocks are looking at their best week in more than 2 months. Is it time to stock up? That's our question of the day with Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager, joins us next. This is Bloomberg.
Tech, I think, is a curious one. I think it remains overvalued for the most part. But I think there are some pockets in there, particularly on the B2B side, where you're seeing much better execution than we've seen for the last 2 to 3 years, and margin uplift as a result. That's pre-AI hype. We're starting to see management teams really focus. And we're really starting to see, I think, the winners beginning to benefit from businesses wanting to consolidate their spending with some of the biggest players. I think that's where I'd look to play growth.
That was Ann Berry, Threadneedle partner and founder, speaking to us yesterday on how her portfolio is positioned, which leads us to the question of the day: is it time to stock up? As I was mentioning, global stocks heading for their best week in more than 2 months. S&P is up 6 straight sessions in a row. This is a pretty powerful rally. Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager, joins us now. Time to stock up?
Yeah, I think that we are basically at that point where the recession fears are starting to abate. We're starting to say to ourselves, we've been talking about this recession for how many months? It's been a really significant amount of talk, and it hasn't happened. And I look at all the people who are talking about recession indicators, and normally we check off each of those indicators. I keep using my eraser to clear out the box.
This week's been fascinating, Katrina. I look at what has been driving the market this week. Industrials have had a pretty good week. The rally's beginning to broaden out. We've been very focused on the fact that it's been driven by a small number of stocks. Is that beginning to change?
It is. You mentioned the industrials, and I have been really much in that camp that the industrials are our new technology sector. You just have a look at exactly what they're doing. They're helping companies. They're investing in IoT. You know, they've got so much going on in that sector. And you speak to these industrial CEOs, and they're positive on their outlook, and they're really positive on the fact that they've been able to use technology, they've been able to use data to help them manage their business better. And that's going to help them work through 2023 and any kind of hiccups that you may see on the demand front, and then position themselves really well into 2024.
Yeah, I mean, S&P Industrial Index has jumped 9% in June. That number, when I looked at it, really surprised me too. And if you take a look at, say, the Russell, the Industrial Index versus the NASDAQ, there obviously is still a huge gap. Does that actually close, though?
I think it can, because if you look at what is the engine of the U.S. economy, and it is the small cap companies, it is those companies that are really, the feeders into those big caps. And I think that we're starting to see signs that our small caps, that differential, as you said, has been at historic levels. And we think that the way that the gap closes isn't through the NASDAQ coming down significantly, it's through the small caps appreciation.
Katrina, Michael Hardner over at Bank of America thinks this rally is going to suck us all in and then it's going to spit us out and slap us in the face. How big a risk is that?
I don't know if he said those words, but that was pretty close.
No, he didn't. That's kind of where he's going with it.
And look, a bear is going to be right every 7 years, probably in this new environment, maybe every 3 years. But the fact is all the evidence that we keep seeing is the fact that this is a mild recession. And let's go back to why. It's the labor market. That is 70% of the U.S. economy is the consumer, and labor has got so much certainty. People or companies are actually talking about the relationship they have with the employees and the need to retain them. And if they retain their labor, people keep their incomes. If they keep their incomes, they keep spending. And that drives the GDP, which is kind of that, the flywheel that we're talking about.
But, I'll put some butts in there, Guy. Today is triple witching. There's a lot of options that are expiring. You can't discount sort of momentum into that. You got CTAs, mutual funds. They've been buying in. Like, we've kind of maxed out on that trade. Like, there are some points that maybe we see some kind of pause here,
But there's also the FOMO trade as well. If you've been in cash, and I've been to get Katrina's take on this, if you've been in cash and this market has taken off, you got a problem, because you're going to look pretty bad at the end of the quarter when somebody comes and taps you on the shoulder and goes, what's going on there? So Katrina, how do you deal with that? Is this a market you now need to chase? If you're behind it, do you need to catch up?
We never want to see portfolio managers chasing markets, because that implies that they're taking on a lot of risk. And that's the way you chase if you're behind. Let's talk about the cash positioning, though. First of all, for a long period of time, we had zero yield on that cash balance. Now you're actually able to get yield in the money market. So that's slightly, influencing those discussions. But as a portfolio manager, I'm paid to find great opportunities. And I just look at all of the opportunities that are out there in the market, and that's what we want to be doing. We want to be looking for those great companies that have really got strong franchises. And I know we keep talking about those margin pressures, but we don't think that those margin pressures are going to be significant. We actually think they're going to be manageable, because we know about them. We're talking about them, and if we know about them and we talk about them, we can manage them.
Even if they don't deal with labor, like even though they keep their labor?
I think that they keep their labor.
They can do all the things. They can walk and chew gum and dance at the same time.
I think that you are underestimating how good the CEOs of America are in their ability to walk that tightrope, because I think the difference is that they've got information and they've got access to that information, so they know exactly what their inventory situation is. They know so much more, and COVID has really heightened that. So people have a lot more visibility, because we just, and that's the other part of this, is we're not going to have an inventory cycle the same way that we've had in the past. And that's what I think is the real cause of those recessions.
Katrina, how long do you think people are going to hang on to labor? When I talk to CEOs in the industrial sector, and I've talked to a fair few over the last few weeks, what they tell me is that they're hanging on to labor because they need to train the next generation of the workforce. They need to buddy these people up. They need to put them with a younger worker and get the training into that younger worker, so that ultimately that younger worker can deliver for them. Is this going to be a kind of long time in terms of the way that is going to work its way through? If you're worried about training the next generation, presumably you've got to keep these people for a while.
Absolutely, and what you're seeing, that training and that attitude towards needing to train labor is really reflecting of the confidence that they have in the longevity of some of these industrial trends. We are starting to see talk of onshoring. You saw the Intel factory that was announced, the investment into Germany. You're seeing your fabs come into the United States. And so you've got a really long tail of investment. Some of it is driven by legislation. Some of it is driven by the concern about resilience of the supply chain. And if you have so much long-term certainty in your business and your revenue outlook, you can take that outlook and bring it into your labor and your labor market. So exactly what you're saying, talking about training people. And also the other thing that they're doing is they're making an industrial career exciting again. They're really trying to convince these young employees that you can go into engineering and you don't just get to be a mechanic, you can get to be a technology expert as well as that. So I think they're really doing everything. I mean, it's textbook and it's great.
Okay, textbook and it's great. That sounds fantastic. Katrina, thank you as ever. Katrina Dudley, Franklin Mutual Advisors, investment strategist and portfolio manager. Talking about this, what is the view from the top? Elon Musk and Bernard Arnault breaking bread in Paris. I think they probably finished lunch now. So when the two richest men in the world go out for lunch, here's the question. Who picks up the bill? Who gets the check? We're going to discuss that next. The startup is coming up from San Francisco. This is Bloomberg.
It is 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. But really, the story is actually in Paris. You have Macron's going to be meeting with Elon Musk. Elon Musk just had a lunch with Bernard Arnault. What's happening there?
Well, the question is, as Guy posed, when the two richest people in the world have lunch together, who picks up the check? I actually have a slightly different answer, which is they met at the Hotel Cheval Blanc, which LVMH owns anyway, and within it there are many restaurants. One of them has 3 Michelin stars, and the chef of that restaurant was seen during lunchtime hours. They're not normally open during lunchtime hours, so I think this is a case of Arnault hosting Musk, and his son Antoine Arnault has actually posted to his Instagram story pictures of all of them gathered, so we know it happened. Anyway, let's continue.
Do we know what they had for lunch? I mean, can we get into that level of granularity?
Our reporting on the ground is very good, Guy, but it's not that good.
Oh, that was it?
For you
Okay,
to
I don't
work
get
on
to
it.
go now? All right, so in all reality, what are they talking about?
So, LVMH, across all of its luxury brands is a big advertiser, on social media, including Twitter. One point that Bloomberg makes in its reporting out of Paris this morning is perhaps they discussed that along with, I suppose, the business environment in France. We know that any moment Musk will go on stage at Viva Tech. Away from Twitter and Musk being the world's richest person and Arnault the second, there is a big question about Tesla's future and what it does in France, because the noise out of President Macron's administration is they would very much like to have Tesla there.
Well, that's what I'm wondering. Is Arnault an ambassador for France in this case?
Yeah, it's an interesting question. We have no idea. I mean, this has played out in so many markets, right, where the commentary from government officials, investment minister, finance minister, right up to the head of state, take Indonesia, for example, makes it seem like a deal is done, that Tesla will go there and do a gigafactory or a battery plant. But it's still very much France courting Musk and courting Tesla and saying, hey, we're open for business. Not necessarily that Tesla is moving forward with a concrete plan.
Would Musk want to go there? I mean, he's already in Germany. Labor laws aren't exactly like super friendly to CEOs.
Yeah, I mean, look, the European electric vehicle market is different to the North American market, just as it's different to the Chinese market. In Europe, as you know, Guy, there are many more battery electric models, smaller form factor hatchbacks from the domestic European players, but Tesla's still popular there. And Musk's logic has always been, hence the gigafactory in Berlin, build the vehicles in the market that you plan to ship them to. Don't ship them around the world from China or the US.
Ed, this just speaks to a wider process, though, that is underway. We've got Intel announcing plants in Poland. Potentially, we're looking at Germany next. There's all politics, industrial policy, and some of these the biggest companies in the world. This whole onshoring process that's happening. It's fascinating to see this unfolding. How early on in this process are we still?
Look, Intel, a Silicon Valley giant, two pieces of news: $11 billion subsidy in Germany, $5 billion investment in Poland. One, move the concentration away from Asia, but B, smart capital. And Pat Gelsinger always said, take the money that's publicly available if you can.
Fair enough. Ed, great stuff. I'll let you work on what they had for lunch. I'm actually genuinely quite fascinated. Ed, Caroline, coming up on Bloomberg Technology with the answer to that question in 90 minutes' time. This is Bloomberg.
have some breaking news for you in the sports world here. So Michael Jordan apparently is finalizing a sale of the National Basketball Association's Charlotte Hornets to a group led by Gabe Plotkin and Rick Schnall. The agreement is expected to be signed soon. This is all according to ESPN. Now, Plotkin had been a minority owner of the Hornets, and Jordan is going to keep a minority stake. So again, this just comes from like ex-hedge fund guys, sort of lots of money thrown around going back into sports. So again, it looks like we're looking at finalized sale, according to ESPN, of the Charlotte Hornets to Gabe Plotkin and Rick Schnall. All right, we are also about an hour into the U.S. trading session. Equity is much higher. So are yields, I should point out, especially on the 2-year, up by about 12 basis points. Abigail's tracking the moves. Abigail?
Yeah, the melt-up continues, Alex. The S&P 500 up 0.3%, its 7th up day in a row. The NASDAQ 100 also up for a 7th day. The Russell 2000 today not participating. Relatively small moves, but where we do have big moves, volume. Volume, the last time I looked, 100% above the 20-day moving average, having to do, of course, with triple witching. Let's take a look at what's happening call-wise, because the call options on the S&P 500 index hitting a record high here. Whether or not this has to do with triple witching or not, it's pretty much straight up the whole year. We'll be talking more about this with Chris Murphy of Susquehanna later today on Options Insight. But investors really wanting to have some kind of a bullish expression here, and it's working for those investors who are either buying these calls or also those who are investing straight up into the S&P 500. Now, Alex was talking about yields. Let's take a look at it. The 2-year yield up 12 basis points, the 10-year yield up 8 basis points. So we still have this yield curve inversion going on, which is pretty significant. In the past, this suggests that there will be a recession at some point ahead. This could have something to do with those UMich inflation expectation numbers, or investors paying attention to what was said on Wednesday at the Fed meeting with the 5.6 median rate on the part of the Fed. And also Jay Powell, I think that he was suggesting that they are still in the hiking camp. And then finally, if we round it out with our last board here, we are going to see that the S&P 500 is essentially, now over this time period it's down slightly, but the bigger point is, Guy, it is essentially where it was ahead of the Fed ever starting to hike. So it's been a pretty significant and, I guess, successful round trip, given the fact that they're taking money out off of the balance sheet, although it's kind of being replaced by Treasury, what Treasury is doing. But also this big hiking cycle, the S&P 500 is back to flat.
It's amazing, isn't it? Absolutely sensational, the rally that we have seen off the lows, Abigail. You think about the turbulence we've been through. Stocks have just looked at it, said, you know what, actually, maybe there's an opportunity here. The pain trade was always going to be up in so many ways. Let's talk a little bit about what is happening in Paris. VivaTech is underway. Elon Musk is currently on stage at VivaTech. He's answering questions from Maurice Levy, the former Publicis CEO, who I actually think looks amazing. I've met Maurice on a number of occasions. He's always incredibly well dressed. Looks very cool today, looking even more relaxed than Elon Musk is. Elon Musk was wearing a suit and a tie, when he met the French president, who didn't wear a jacket. Check the footwear out. If you get a shot of the footwear, worth watching. Anyway, I think it's on Live Go. So if you want to see what's happening there, Maurice looks amazing. Anyway, let's talk a little bit about
like an Access Hollywood commentator right now.
Precisely, new skill set. It's going to be one I'm going to have to work on, I think. But look, he looks great. Great. I hope we all get to age in that way. Let's talk a little bit about, I'm going to try and think of a connection here between Elon Musk and China, but obviously the gigafactory in China is probably the way of doing that. Industrial relations between China and the United States have become more and more difficult. Secretary of State Antony Blinken is heading to China, becoming the most senior US official to visit the country in 5 years. For more on what the leaders will be discussing, let's bring in Bloomberg's Ender Curran in Washington, who I'm sure is going to look fantastic as well. And how high should my expectations be for this trip?
Not very high, Guy. I think all the messaging here has been about managing expectations. No one's really looking for a breakthrough. There are maybe more than a dozen topics on the table there, everything from Ukraine, Taiwan, industrial relations, human rights in Xinjiang. You go through the list, and nobody's really expecting any kind of material resolving of the differences in those issues. I think the first thing to look for will be basically the reception that Mr. Blinken gets when he arrives. How will the Chinese official media respond, because they obviously message for the government, and will he get to see President Xi Jinping? As you mentioned, he's the most senior US official to visit China in 5 years, so there's a lot riding now in terms of how he is received, and then by extension what that means for potential visits by other officials in the months ahead.
And do the players at play have deliverables, or are we like not even at that point yet?
It feels like the deliverable, Alex, will be just getting there and stabilising relations, which we know have been on such a spiral and took that extraordinary hit after the balloon incident back in February. I mean, the messaging so far that's being reported out doesn't suggest there will be anything especially tangible on some of those critical issues, Ukraine, Taiwan or anything else, but it's more about being there and how he's received, I think.
And Kissinger's warning that we need to calm things down a little bit. Is that what this is?
I think that's exactly what it is. You saw those manoeuvres in the South China Sea, the near miss between those two boats, and of course the aircraft as well in recent weeks. You saw the mood music at Singapore. The language from China's defense minister was very punchy towards the US. The defense minister still refusing to talk to his counterpart. There's a lot of very negative areas right now, insensitive areas between the US and China, going beyond economic competition into worries about security now between both sides. So definitely at the very least, this is about trying to get some guardrails and cool down those differences, I think.
Yeah, and Guy, it really comes out too that it feels like Taiwan and tech are like two immovable objects when it comes to the US and China. Guy, and I'm not really sure what moving the needle on either of those two things actually looks like at this point.
Taiwan is clearly a huge risk. We've been talking about it already, Alex. You look at what is happening in Germany. You look at the investment that Intel is making into Poland. You look at what is happening in the United States and the impact that the CHIPS Act is having there. In some ways, we're trying to de-escalate Taiwan by deindustrializing Taiwan. And I wonder whether that's going to be the long-term takeaway from all of this. If Taiwan becomes less important to everybody, maybe we don't need to worry quite so much about it.
But then the flip side, and we have the Micron news today, right, which they say that they're going to lose revenue because of China, but then they're also going to be investing in China. I can't quite figure out that kind of strategy.
Yeah, there's a lot of complexity going on in this story. I mean, you also see New Zealand's Prime Minister going up to Beijing for trade talks. You see Poland and I think it was Belgium agreeing to sell beef to China for the first time in more than 20 years. You'd have to say the whole de-risking strategy, at the very least, is off to a slow start. It does show you how complicated and interrelated the US and Europe and China are now economically, which does make this a complicated conversation. And to your earlier points, that's why I don't think Secretary Blinken's going to land there and there will be any binary outcomes on any of these issues. It's more about reopening communication channels and getting them talking on some of these key points.
Right, just like say words to each other and like that's success. And thanks a lot. We really appreciate it. Great to see you, Bloomberg's Enda Curran, joining us now. All right, coming up, we're going to have an interview with IMF head Kristalina Georgieva on why the organization is calling on the ECB to embrace a tightening bias. It seems like Christine Lagarde would agree with her after yesterday's presser. This is Bloomberg. Keep tightening. That is the message from the IMF to the ECB. In a new report out today, the International Monetary Fund says a tightening bias is necessary to combat stubborn inflation. Maria Tadeo is in Brussels with Kristalina Gorgieva, IMF Managing Director. Maria?
Indeed, and she is here with me in the studio. Madame Georgieva, is always very good to see you. And to some extent, you're back home because, well, you're Bulgarian. You used to be a commissioner. You have been on a European tour. You were in Luxembourg. Today, you're in Brussels. And I know you watched that press conference yesterday from Madame Lagarde. The message was very clear. We've got to hike. Inflation is still too high. Is that something you would endorse?
That is something we endorse wholeheartedly because while headline inflation seems to have peaked and is going slightly down, core inflation is very stubborn. And in our projections, we see inflation going to the target of ECB only sometime in 2025.
That's very far off.
Too long, too high. And so we think that some further tightening would be necessary to bring inflation firmly under control. And let me say why this is so important. Because if inflation continues to run high, one, that means interest rates have to stay higher for longer. When they're higher for longer, financial vulnerabilities could get exposed. Two, high inflation, high interest rates, inevitably this is going to impact growth. And we want the European economy, the world economy, to grow. We worry that our projections for growth are kind of on the weak side. We only expect growth at 3% over the next 5 years. We have to get out of the inflation trap to create a better environment for stronger growth.
And that was essentially what Madame Lagarde also said yesterday. She also added, by the way, July, get ready for it, there will be another hike. The debate today in Europe, everyone's talking about this is, will there be another one in September? I'm not sure if you want to give me a number of how many more hikes, but is that something that you say July, September, whatever is needed?
I would say Madame Lagarde, ECB, they're guided by data. They would watch the data very carefully. They would make a decision on that basis. If inflation continues to be resisting the actions they take, they will have to do some more. Of course, for the good of the economy, we also have to make a call to the fiscal policy side.
Yes.
Please don't spend too much because you spend that pushes demand up, that pushes prices up, and then rates have to stay higher for longer.
And you met with finance ministers yesterday. Are they listening to you, or do they tell you, my problem is there's elections across Europe, the energy situation, by the way, prices shot up yesterday still. It's difficult to fine-tune that. Do you feel they listen to what you're saying, or it's still very difficult to navigate that space?
They see the problem in front of them. I mean, we are in a situation when monetary policy is putting a foot on the brake. Well, if fiscal policy steps on the accelerator, we are for a very, very bad ride.
You're going to crush the car.
Everybody understands that. We would crush the car. The problem is that putting measures that support households and firms is easy. Pulling them is hard. And yet policymakers have to have the courage to let these measures expire. If we get hit by another round of peak of energy prices, then they can support those who need it. But take the time now, be prepared to be more targeted, so it is easier to carry on the fiscal front.
And speaking of crashing, hopefully not, but yesterday we had Peter Pratt on the show, and of course a former chief economist of the ECB, and he did say the soft landing, however, it's becoming hard now for the ECB. Do you trust Madame Lagarde? Do you think she can get to that point and build that consensus, make the right choice?
I inherited her job at the IMF. She has done a fabulous job there, and I'm sure she would do a very good job for the European people. And I trust her because the ECB has been very, very focused on what is the story data tells them, and then make decisions on that basis. And something that I find remarkable, we don't talk enough about it, is how much more coordination, cooperation there is across major central banks.
You would say there is, because some would say it's starting to look a little bit all over the place. Some cutting, some maybe going, we're going to pause, reassess. The ECB yesterday shut that debate down. They said we're not going to pause.
Well, let's remember that ECB started somewhat later than the Fed. And the situation in Europe is different from the situation in the US. How is it different? Well, first, the US has not been hit as hard by energy prices. Europe suffered a bigger blow. What does it mean? It means Europe had to give more help to households and to firms. And that, of course, pushes demand up. And the second way in which Europe and US are different is what we see in the United States is that the actions of the Fed are showing that there is some softening of the economy. Here, I love being in Brussels. I go around, well, restaurants are full. People are at work.
And that's the problem, isn't it? The services is going strong, the manufacturing,
yes.
However, there's a lot of fears in Europe about
yes.
the future of that sector. Did you fear that?
Oh, you see it in the data. Countries that are more dependent on contact-intensive industries, say tourism, they were badly hit in 2020, but now they are recovering very strongly. They have higher growth, whereas countries that are more manufacturing dependent, more affected by energy prices, more affected by the whole energy transition that Europe is carrying, and more affected by external demand for manufacturing products. You see what is happening in China, slowing down. Yes. China slows down, Asia slows down.
How much do you fear the Chinese impact in this?
Well, the Chinese...
It looks like they want to stimulate the economy.
They have ample fiscal and monetary policy space. They were very cautious in prior years, and this is why the Chinese economy, one, being locked down, two, not enough policy support. It went last year in the unthinkable average growth lower than the global average. Never happened in 40 years. Now they are starting to inject a little bit of policy support to the economy. But I'll tell you, I look at China, it has affected the real estate market.